Okay, so let us continue again from here. So we talked about the kind of money and all those things. You can refer to the two videos that I put. The first one I just put monetary sector. The second one is monetary sector 2, lecture note 5. Okay, continuing from here, the central bank. So what is the central bank? I'd mentioned to say the central bank is simply the apex highest institution that is put to be the financial um, the one that is in charge of the financial system in the country or the economy. Okay, it is there to simply control and supervise the banking system and everything that we have to look at. Probably we can talk about it controlling how the monetary sector is working and maintaining the economy stability. Okay, so the main functions of this central bank are that it has to like conduct monetary policy. What it means is that you're going to find that the bank, this central bank, is there to control how much money is going to be supplied in the economy. It is also there to talk about how much interest rates are going to be there. So when you talk about the monetary sector, just defer to the fiscal policy. Fiscal policy, we talk about um, the government's expenditure and the revenue, and the monetary sector was simply talking about the government's, the central banks, how the central banks create money and how they supply the money, and of course how they increase the interest rates or reduce them in the economy. It as well acts as a physical agent for the government. You find that the government, it's more like, sorry about that. So it is going to act as a banker for the bank, for the government. Whatever money that the government owns is kept in the central bank. So do not assume that when the government, we say the government has money, the government goes somewhere else. No. The government is the one, the central bank is the one that keeps the government money. Okay, the money that is owned by the economy is kept in the bank, I mean the central bank. Okay, so the money that the government receives, the money that the government makes, the payments, the bonds that the government issues, and everything like that. Okay, so the central bank is well as well is going to act as a banker. Okay, so what do we mean by acting as a banker? It will simply act as a banker in a way that, of course, the government can go there if it has money. It goes there and it puts money, like I'm just from saying, it will keep money. And again, it can act as a banker for banks. Okay, for banks, we have central banks. The central bank is the main bank, right? That always issues money, it will issue currency, it keeps money for the economy and all those things. Now, central banks are banks that um, attend or save these people in the economy. So it keeps money for those banks. If a bank like Zanaco goes to the central bank to deposit money, it will leave money some to there as a reserve, right? And in that same reserve that it has left there, a reserve for the central bank, yeah, which is an asset for the central, which is an asset for the, what do you call it? The commercial bank can be a liability for the central bank. Okay, I hope I'm making sense. So this central bank can be used to issue currency. You find that the currency that is being made, it is supposed to be designed by the central bank. It's supposed to be managed by the central bank and everything. The coins, the banknotes, the arrangements, the production, distribution of the money, and replacing all the damaged money. So you find that if the money is damaged and everything, the central bank is involved, or it is the one that supplies the money that is damaged. Okay. Moving on to the management of foreign exchange, you find that these same banks are the ones that act in a way that they are going to manage all the transactions that come from the foreigners. Okay, these foreign countries and everything. As well, it simply puts foreign currencies in Zambia. So you find that it is the one that is puts those in Zambia. So if you want to change your money into another currency, you have to those small banks have to get currency from there and they change you. Okay, so that is all about the bank, the central bank. Okay, now we can talk about the central bank and its balance sheets. So the balance sheet for the central banks contains the assets and liabilities. What are these assets and what are these liabilities? Assets are simply things that the bank owns. Okay, so these are money, the bonds, the treasuries, and everything that the bank owns are the things that we're calling what? Assets. Liabilities are simply things that the government um owes others, like debts, um any other things, are those things are called what? Liabilities. So like I'm just from saying bonds, treasury bills, bank loans, are loans from the banks, or to the to the banks. Foreign currency. So if someone from another a foreign country comes in and they deposit, that is an asset to the central bank. And then if the notes, these current notes that we have, right, that are being held by the public, are considered to be part of a liability, because the government does not own that. That is for the public, so the public can just go there and demand for it. It is theirs. The government deposits. So if the government goes to the bank, the central bank, and deposits money, then it means that that is a liability. Okay, so we can as well talk about other deposits that can be made, either deposits that are made by the government, deposits that are made by commercial banks, and deposit the circulation of what? And circulation of currency. Okay, these are the things that we can talk about: the liabilities and the liabilities and the assets. Okay, so central bank balance sheet, which we are just from talking about. We've talked about this part and we've talked about this. Without even wasting time, we can just move on and go to the central banks. Okay, so the central banks um, are simply smaller institutions that are responsible for These central banks are responsible for it acts as a third person between the borrower and the lender. The borrower and the depositor. Okay, so you find that the commercial bank is going to act as a financial institution that accepts deposits from those people that are here to deposit, and then it is as well going to, from those depositors and from different businesses, and that same money that it gets, it is going to give out that money to borrowers. The central bank does not get money and then give people. No, people get money from commercial banks. Okay, commercial banks are banks like Zanaco, Absa, Stanbic, and all those other banks. Okay, so you're going to find that these commercial banks will get money from people, right? If someone comes to the central bank, to the commercial bank, they go there, they deposit money, and then once that money is deposited, another person is going to come, right? And then they borrow some money. That person again will go to another bank and deposit, just like that, just like that, just like that. So functions of the commercial bank: this commercial bank can act as a financial uh, as a bank, as a financial internet. Okay, or let me just say as a bank, right? Of course, we know that it is going to be there as part, if a person comes in, or how can I put it, as a mid person. Like I said, I want to deposit money, I deposit. Someone else comes in, they want to lend money, they want to borrow money, they borrow the same money that I deposited. But the bank is going to act as the financial interconnection between the two of us, the person that borrowed the money and me who deposited that money. So the central bank can as well act as a as how can I put it? Okay, how commercial banks make money. Let me just talk about that. So I'd mentioned to say these commercial banks, if someone comes to them, they deposit money, right? That money, the person that comes in to borrow money will be required to repay back with interest, right? So these commercial banks, the person that comes deposits money will be given less interest compared to the person that will borrow the money. So that person, for example, if I go to the bank and I deposit maybe let's say 100 kwacha, they'll just give me maybe 2%, right, as my interest. But the person that is coming in to get this 100 kwacha, maybe rather they can't even give the person a 100 kwacha because reserves are supposed to be left out. So maybe a 80 kwacha, this person get a 80 kwacha. So this person will be required to pay back maybe 5%. So this person will have maybe let's say 10%. This person will have to give back more than what the bank is earning. So the bank will have more. Okay, it will have money there, just like that. And then demand deposits. These are simply deposits that this bank is simply a bank that only acts in a way that you're going to find that their current bank accounts, savings account, what accounts. So if you deposit whatever deposits that you put, it means that you have a demand deposit. Okay, if you haven't put it in the savings account, it means that you can just go today, you deposit today, and tomorrow you just wake up and go there and claim your money. You say, okay, I want my money back, and they have to give you because it acts as a bank that has to save the people there and then. Okay, for the demand deposit. That's what we call that. Then as well, we can put it in a way that we, of course, all these things that we've talked about sounds to be okay, right? Sounds to be nicer compared to the commercial bank. I mean, compared to the central bank, because the central bank is only going to be saving the country and these same banks, right? We can as well now talk about the issues that this bank is going to encounter. This bank only has two problems that it faces. Okay, that's the reason this bank has to leave reserves. One is that if someone comes in the bank, right, they deposit money. That money, if the bank decides to get maybe 10% of the money, it keeps it as a reserve, you're going to find that it will end maybe that all of the whole money that it just got 10%, right? The whatever money that is going to remain, it will lend it out. If it lends that money, it means that it is going to mean to get money, right? So the more it lends the money to people, the more it gets money. The more it lends, the more it gets money. But the problem comes in to say that borrower can, I mean, that depositor can come any day and claim to say, I want my money. So that's the reason the government cannot remain blank. For that reason, the central bank is going to instruct these banks to say, these commercial banks to say, you guys are supposed to remain with a specific amount. Okay, you're supposed to remain with a specific amount of the reserves. So maybe you're given to say, whatever deposit that is made, you must keep maybe 20% as a reserve in the bank. Okay, that is how the commercial bank and the the central bank can as well interact. As well, we are going to have the the assets and their liability part. So we are going to find that if the bank, if someone comes and deposits money, a multiplier is created. Okay, a multiplier is going to be created in that process where the bank, where the bank receives money and the money goes to another person, just like that. Because if I go to the bank, I deposit a 1,000, the central bank tells the commercial banks to say you have to keep maybe 20% of the money, that whatever money that is come that whatever money that it comes in, right? I deposit 1,000 times 20%, I'll get to they'll get 200, and the 800 is going to be deposited. a multiplier is going to be created here. So we simply say, so we're going to say that a multiplier is, sorry about that, so we're going to find that we are going to have 1 over the reserve ratio. So the reserve ratio here is simply, we can try to get this 20%, I mean this 200 to this percentage, which means that we have 200 over 1000 times what? Times 100. This is the ratio that we're talking about. So the number that you're going to find here, you put it on top here, you find it, you put it here, but it should be in normal tens. So like here, whatever ratio that you're going to find, it is going to be in percentage, right? So you can take it, you move it 1 over 0.2, so it is not in percentage anymore. If you divide there, it is going to give you 5, right? So the multiplier there is 5. So if I deposit a 1000, the multiplier there, it will tell me to say that my maximum 500 1000 that I deposited, it has brought about 5000, right? So this is how the multiplier works. Okay, because the money that I will deposit will be borrowed, some money will be borrowed from the money, and that person that borrows it deposits in another bank. Just like that, money is going to be being multiplied, just like that. Not necessarily that this bank is printing money, no, but this bank is simply just depositing funds and lending money to borrowers, as simple as that, because the central bank is the one that is involved in printing the money. Okay, so this is all about this part to do with the commercial bank and everything. So this is where the credit creation is. So we simply are talking about when you get the money, someone deposits money in bank A, and then the bank A lends 80% of that money to the person A. That person lends, deposits money to bank B. Another bank B person gets money from, just like that until the rest of the time. So we're going to find all these calculations in once we start with the calculations. For now, I just want you guys to understand the notes, and that's all. Watch the next video to understand more of what we did in this lecture note. Subscribe to the YouTube channel. Stay safe.